When you talk about options, there are regular options, of course, but there are also LEAPS, and so we're going to talk about that today with our guest, Marty Kearney. Marty, first of all, can you define what a LEAP is?
Sure. LEAPS are, when you look at the acronym LEAPS, it's long-term equity anticipation securities. So technically they're not options, they're actually securities. But they're really options for a longer length of time, going out as far as about 30 months in the U.S.
All right, so why would you use a long-term option like that?
Well, long-term options, not every option play is a short-term speculative play on earnings or the money supply or whatever you trade short-term. There are many people that use LEAPS as a long-term holding, the same as stock. For example, we had an advertising campaign at the CBOE many years ago, and it was very popular. It was the first successful advertising campaign we had. I was a floor trader, so I think we dropped it immediately because we had never had a successful advertising campaign, all right? And the advertising campaign was, why buy a stock if you can lease one? We just finished rolling out the balance of our LEAPS for 2014 at this point in time. It's out to January of 2014. So why buy 100 shares of XYZ at $80 a share? Why don't I lease one by buying a LEAP call option going out 1 year or 2 years and get the same bang for my buck? I have less risk. I have a great deal of leverage. Now, I don't get the dividend. I don't get the voting rights. I don't get invited to the annual meeting and they serve wonderful peanuts. It's, I think, catered by United Airlines. I'm not sure. But the whole point is that, I have limited risk and I participate on the upside with the leverage of using long-term options.
What's the time decay chart look like on a LEAP?
Well, time decay, this is with at-the-money options. The closer we get to expiration, we kind of drop off. The LEAPS, there's a little bit of vertical displacement as we go along. But when they get down to options having 3-4 months to go, all of a sudden they start to act more and more like options, regular options.
So I can imagine this being a scenario where you've got a company you think is going to do great. You're not sure which time frame. They maybe got a year or so to work out.
Sure.
Bad business environment.
Right.
This would be a good opportunity to do that.
Absolutely. Or I don't have the money right now. I love this stock. I'd like to buy 1,000 shares or 2,000 shares. I just don't have that money. Maybe I can cobble this together with a long-term option. And you can also, by owning long-term options, you can actually sell short-term options against it. So it kind of mimics the covered right. Maybe we can lower the cost of owning those LEAP options by selling an equivalent covered calls. What
would be an example of a time when you would say you own 100 shares of XYZ, you want to hedge that a little bit in your portfolio, you want to hedge it for a long time? Would you buy a 6-month out regular option or LEAPS? What would be the decision?
Well, one way to hedge it, if I own shares of stock, I know a couple of people, and one firm in particular, where they have portfolios set up where they're buying LEAPS put options on the stock or the basket of stocks if it's an ETF, and they're also selling short-term calls against it. So you know what, this kind of mimics the collar, doesn't it? Where I have long-term protection with the LEAPS put, and I'm selling short-term call options that are falling off the face of the earth as the time decay comes in.
All right, and where do I find information or data about LEAPS?
CBOE.com is a wonderful site. I wrote a book, Understanding LEAPS, with Mark Allaire. I don't know if it's still in print, but there's a great deal of information at CBOE.com.
Marty, thanks for your time.
Thanks, Tim.
You're watching the MoneyShow.com video network.